This is shaping up to be one of the ugliest weeks the market has seen in years. Read across every major index, panic in the headlines, and if you've opened your portfolio app even once today, you already know exactly what I'm talking about. But here's why I actually want you to stick around instead of closing this tab in fear. If you've got even a single dollar sitting in stocks or ETFs right now, what happens over the next 2 weeks is going to matter more than almost anything else you do financially this year. Not this quarter, this year. Because weeks like this one are where fortunes quietly split in 2 directions. Some people watching this exact video are going to look back 12 months from now and say this was the moment they got in. Other people are going to look back and say this was the moment they gave up, sold at the bottom, and watched everyone else recover without them. And the uncomfortable truth is right now, today, sitting here watching this, you genuinely cannot tell which group you're about to be in. That's not me being dramatic for views. That's just how this works. So here's the thing nobody actually explains to you about a crash, and it's the single most important idea in this whole video. A stock that's about to double over the next 18 months, and a stock that's about to go to zero on day 1 of the drop. They look identical. Same ugly red candle on the chart. Same scary headline scrolling across EMB. Same panic comment section telling you to sell everything and hide in cash. There is no flashing neon sign that appears on your screen saying, this one's the opportunity and this one's the trap. Both of them feel exactly the same in your stomach. Both of them look exactly the same on a chart. So the real question isn't whether you're brave enough to buy a dip anyone can click a buy button. The actual question, the one that separates people who build wealth from people who get wrecked, is whether you know how to tell the difference before you click that button. And that's what we're solving today. Here's exactly what's coming, in order. And I want you to stick with me because the order genuinely matters. First, I'm giving you a simple 3-part test, something you can run on literally any falling stock, anytime, for the rest of your investing life, not just this week's picks. Second, once you've got that test, I'm walking you through 3 stocks that I think are genuinely on sale right now, not just cheap for the sake of being cheap. Third, I'm going to name 1 stock that everybody on this platform is hyped about right now, that I personally think you should stay far away from, and I know that's going to upset some people, but I'd rather be honest than popular. And fourth, at the very end, I'm telling you the 1 pick out of everything we cover today that I'm personally putting my own money into this week. Not hypothetically, actually buying. So if you only watch for one thing, that's worth waiting for. Quick context, if you're new to this channel and don't know who's talking to you, before I ever picked up a camera, I spent years working on a trading desk, watching exactly this kind of panic play out from the inside, watching how institutions actually behave during weeks like this one versus how retail investors behave. I left that world to build the academy behind this channel, which today has grown to north of 25,000 people going through it, learning how to actually read markets instead of just reacting to headlines. And one thing I want to be upfront about, unlike a lot of finance channels you'll come across, we don't take sponsorship money from the companies we talk about on this channel, ever. Which means when I tell you I like a stock, or I don't, that opinion is genuinely just my read on the numbers, not a paid placement dressed up as advice. So let's get into what's actually bugging people this week, because this is the part that genuinely confuses most investors. Companies have been coming out with earnings, beating revenue expectations, beating profit expectations, hitting every single number analysts ask them to hit, and the stock still gets absolutely crushed the very next morning. That feels broken. It feels like the market is lying to you or rigged against regular people. It's not. There's a real, explainable mechanism behind this, and once you understand it, you genuinely cannot unsee it for the rest of your investing career. Reason number 1 is expectations, not results. The market never prices in what a company actually did last quarter. It prices in what everyone collectively assumed it would do. So when actual results come in merely great instead of extraordinary, that gap between great and what everyone was secretly hoping for shows up as a sell-off, even though the underlying business is completely fine. Think of it like getting a minus on a test. Everyone expected you to ace with a perfect score, objectively still a great grade, but it still feels like a letdown in the room. Reason number 2 is rotation. Big funds don't sell a stock because they suddenly hate the company. They sell because they need to shift weight into a completely completely different sector that's come into favor that week, and your stock gets caught in the crossfire of a trade that has absolutely nothing to do with its actual business. It's collateral damage, not a verdict. Reason number 3, and this one genuinely surprises people the first time they hear it. Sometimes it's just liquidity. A large institutional holder needs cash for a completely unrelated reason, maybe to cover a redemption, maybe to rebalance a fund, and they sell off a chunk of an otherwise perfectly healthy position. That selling pressure alone can drag a stock's price down for a day or two, with zero relation to how the company is actually performing. Once those 3 forces click for you, you stop seeing every red day as automatically bad news. You start seeing it as noise sitting on top of a signal, and that's exactly where the opportunity hides, in the gap between how a stock is trading and how the actual business underneath it is doing. Be honest with yourself for a second. How many times have you watched a stock you actually liked drop 15, 20%, told yourself, I'll buy it back cheaper, and then just didn't? Because down there in the middle of the red, it somehow felt scarier than it did at the top when everyone was excited about it? Drop the ticker of the one that got away in the comments below. I promise you, you are nowhere near the only person in this comment section with that exact story. Real quick, if you're getting value from this video, hit the like button and subscribe. Now let's get back to the next part, because this is where things get really interesting. Here's part of why that happens to almost everyone. By the time a headline actually explains why a stock is falling, the move is basically already over. The news is reacting to the price, not the other way around. You're always reading yesterday's explanation for today's price action, which is exactly the gap we built our live session around. In that session, I actually share my screen and show you the real dashboard we use to catch this stuff developing in real time, not after some finance blog has already written the recap. There's a link below if you want to see it. But let's finish building the framework itself first, because that's the part you can use forever, with or without the webinar. Step 1 is the business check. Forget the stock price completely for a second, and just ask yourself plainly, did anything actually change about the company this week? Did they lose a major customer, take on dangerous new debt, get meaningfully outcompeted by a rival? If the honest answer is no, that's your first green flag that this might be noise rather than a real problem. Step 2 is the sector check. Pull up how every other company in that same space is trading that same week. If the entire sector is down together, that's a market-wide mood swing, a macro fear event, not a company-specific red flag. And that's a completely different situation than if your one stock is the only thing bleeding while its competitors are fine. Step 3 is the smart money check. You look at whether institutional ownership and insider buying are holding steady or even increasing right into the dip, because the people sitting closest to the actual information rarely sell aggressively into a crash they genuinely believe is temporary. I run all 3 of these checks live inside the platform I personally use, and if you want to try it yourself, there's a free trial link down below as well. Quick, important note before I start naming actual companies. Everything from here forward is my personal opinion and how I personally think through this. Purely for educational purposes, it is not individualized financial advice for your specific situation. Please do your own research on top of this, and only size any position to an amount you can genuinely afford to be wrong about. First name Intel. Running it through the filter step by step on the business check, there's no fundamental change to the underlying company this week. On the sector check, the broader semiconductor space has been soft as a group lately, rather than Intel specifically getting singled out and punished. And on the smart money check, recent filings have shown accumulation rather than distribution into this exact weakness. Now, the honest counter-argument, Intel has had real execution problems for years, and a turnaround here is not guaranteed just because the chart looks cheap. But at current levels, I think the market is pricing in something closer to permanent failure for a company that is still profitable and still has meaningful backing tied to domestic chip manufacturing policy. Second QQ key, the NASDAQ 100 fund. This one passes the sector check almost automatically because it's diversified across 100 different large companies. So a broad pullback here tends to signal macro-level fear rather than any specific company falling apart. Historically, sharp pullbacks specifically in this fund have more often than not been followed by a recovery, though I want to be honest that past performance never guarantees the next time plays out the same way. And if this particular dip turns out to be a genuine regime change in interest rates or growth expectations, that history matters a lot less. Third, Philip Morris. Different flavor of pick here because this isn't a growth story, it's a stability story. The business fundamentals haven't shifted at all. The dividend has been maintained, and this is exactly the kind of steady name that tends to get sold off reflexively during broad market fear. Even though its earnings aren't actually tied, that tightly to the broader economic cycle. The real risk here is regulatory. Always new restrictions on tobacco or vaping products can hit this entire sector out of nowhere. So that's genuinely the thing to keep watching. Now, a lot of you watching are going to want to skip this next part or get a little annoyed with me for it, but I have to say it anyway. Tesla. I know how loved this stock is in comment sections just like this one, but running it through that same exact filter, this drop isn't sector-wide weakness. It's largely stock-specific. Delivery numbers have been genuinely inconsistent lately, and I'm just not seeing the same level of insider conviction here that I am in the three names we already covered. That doesn't mean it can't rip higher on pure sentiment alone. It has absolutely done that before, more than once, and could again. It just means it fails my personal filter right now, and I'd rather tell you that honestly than tell you whatever's popular to say. Whatever you decide to do with any of this, please don't go all in on day one of a dip. Scale into a position gradually over time instead of trying to catch the exact bottom, because nobody catches the exact bottom consistently, not you, not me, not people who've been doing this for 20 years. Keep your position sizes small enough that being wrong doesn't wreck your entire week emotionally or financially, and decide your exit point before you ever buy, not after, because the worst investing decisions almost always get made in the moment under pressure with no plan already in place. So that's the whole thing. Start to finish three forces that explain why genuinely good companies crash, a three-part filter to sort real opportunity from real trap, and four names run through that exact filter live in front of you. What we just did together is turn a gut feeling into an actual repeatable system you can use again next month, next year, whenever the next scary red week shows up. If you want to see the same filter applied live to whatever's moving in the market that week, the webinar link is below. We don't post replays of these, so if you want in, this is genuinely the window. And if any of this helped you see today's sell-off differently, send this video to the one friend who's been panic texting you all week. One more thing before you go. There's a defense spending bill moving through Congress right now that, if it passes exactly as currently written, would be the first time in over a decade that a specific category of contractor gets funded in an entirely new way. I'm breaking that whole thing down in the next video, because if it actually goes through, it's going to move a handful of stocks that almost nobody is talking about yet.